Welcome back to our real estate vlog.
Hey everyone, this is Daniel Vera.
And I'm Tony Brucato. We're both real estate agents at Keller Williams Realtry Services. Daniel, selling houses in the Cincinnati, Ohio area. I service Northern Kentucky. Today, we would like to give you all some brief pros and cons to think about when you're deciding what mortgage loan is going to be right for you. Typically, your lender is going to be able to talk more in depth with you about your loan when you arrive at that point, but at least you'll have a general idea of what the differences are. So, let's go ahead and talk about the four major types of loans available today for the residential buyer.
Thanks for that, Tony. The first loan we want to go over is the conventional loan. This is a very popular and solid loan type that can look very attractive to the seller if used properly. The pros of a conventional loan include low down payment of only 3 to 5% required by the lender, no PMI or private mortgage insurance with 20% down payment. PMI will also be automatically removed when the loan to value ratio reaches 78%, and conventional homes can be used for a second, third home, and investment purchases. For those of you that don't know what private mortgage insurance is, it's an additional payment added to your mortgage payment that goes towards insurance that protects the lender if you were to stop making payments or default on your loan.
Cons for the conventional loans include higher interest rates for those with a lower credit score, such as these. Debt to income ratio limits, which include 28% on the front end and up to 43% on the back end. Tougher credit score guidelines, where lenders typically like to see your score at a minimum of 620 to 640. And lastly, banks require at least 2 months of PITI, which is proof of funds worth of liquid assets that can be in addition to your closing costs, which typically include third-party fees, appraisal fees, taxes, etc. But these liquid assets could come from your checking, your stock, trust funds, 401k, or even cash, but must typically equal 2 months of a mortgage payment.
Thanks, Tony. Now let's talk about FHA loans. Here are the pros for FHA. A low 3.5% down payment required, typically can have better rates than conventional depending on the market for low credit borrowers. More lenient credit score guidelines than conventional. Here are some pre-COVID stats for FHA guidelines. And lower mortgage insurance rates or premiums than conventional loans that are additional payments usually added to your monthly mortgage to cover the lender. Here are the cons of an FHA loan. If the down payment is less than 10%, the mortgage insurance premium cannot be canceled for the life of the loan. Many people end up refinancing to a conventional loan later because of this. Another con is many condos are not approved by FHA limits. Owner-occupied homes are approved, meaning no vacation or investment properties. And last, there are loans based on region or counties.
USDA loans. Let's talk about some pros with that. No required down payment, which can be huge for some people. No prepayment penalty. Ability to finance closing costs into the loan. Use similar credit score requirements as conventional loans. And can still provide a low fixed interest rate based on the housing market. Here are some of the cons with USDA. They are restricted to rural areas. They have a maximum income limit. For example, as of May 4, 2020, the standard USDA loan income for a 1 to 4 member household is $90,300 and $119,200 for 5 to 8 member household in the U.S. counties, according to USDAloan.com. Lastly, mortgage insurance is always required, and you are restricted to single-family homes only.
Our last loan to discuss is a VA loan. To quickly answer the obvious question, do you have to be a veteran to get a VA loan? The short answer is no. However, VA loans are generally for veterans and spouse together, or the surviving spouse of a veteran under certain circumstances. But some non-veterans are allowed to apply The VA official site describes who may do so under the current rules of the VA loan program, and your lender can help you further investigate your situation and needs.
Here are some of the pros of a VA loan. 0% down payment. No private mortgage insurance is added to your loan. Debt to income ratio requirements are less than other mentioned loans. And there is no prepayment penalty, which is nice.
And let's mention some of the cons of a VA loan. There is a VA funding fee that can be either paid up front or rolled over into the cost of the loan. Approved for a primary residence only, sellers might not accept your offer due to the possibility of a VA inspection having more strict requirements to having things fixed and updated. And lastly, you must sell your current home or pay off loan completely to use a VA loan again, meaning you can't go write an offer on a new house until you have sold your old one.
That stinks. But this wraps up the highlighted points on conventional FHA, USDA, and VA loans. We hope this video gave you a little more insight. Please let us know if this video was helpful at all. Please like, subscribe, and share, and stay tuned for more real estate content to be put out by your real estate support advisors. We'll see you next time.